So when we start talking about the consumer and wages and the struggle here, we just wanted to rehash this specific chart from previously. When we look at real disposable income, which is well below where real disposable income trend was prior to COVID. And when you look at where things are going, well, real consumer spending is still staying elevated, but there's a lot of cracks that are forming, which we've seen and we're starting to see ramp up. So when you look at spending, it was at 0.8 in July. Inflation adjusted was 0.6. Disposable income, inflation adjusted, was negative 0.2. And if you look at August, which is going to have hotter inflation than we saw in July, we actually see wages falling. We see wages weakening. So that's going to make the inflation adjusted even worse because we're seeing inflation accelerate to the upside and wages fall to the downside, which is going to increase that stress point as savings rates are sitting at 3.5%, which is down 0.8%, which isn't sustainable. That's again because people are pulling out of savings at another aggressive clip to try to close that gap. And eventually the gap can't be closed because they've already done it with credit. They've already wrapped up their savings. The next option is just to stop spending. Millennials missing credit card payments. When you look at the ages of 30 to 39, you can see that it's up to 7.1%. It is still not where it was prior to COVID. But when you start looking at these missed credit card payments, we continue to see this, again, trending higher. And it's unlikely to stop because when you look at delinquency rates for 30 to 39, that core piece, auto loans are way above pre-COVID levels and are approaching what we saw in 07 and 08. Now, it's important to, and the reason why we bring that up is because typically auto loans will lead credit card delinquencies. I should say auto loan delinquencies will lead credit card delinquencies. And that's where when you look at the rate of change, it's massive. And the problem is credit card rates are going up. Credit cards, I think MasterCard and Visa, it was either yesterday or the day before, announced they're going to raise fees. So again, you're seeing pressure at a lot of levels. And as those go up, and the problem with credit cards, it compounds. So if you don't pay anything, you're getting hit with 24% interest on that. And then that then compounds and then another 24%. And you continue to see this climb higher, which creates this treadmill that you're never able to get out from underneath. Wage and salary growth reaccelerated in 2Q at an annual pace of 5.4%. Since market trough of last year, consumers have felt more optimistic that stocks will continue to do well. But then when you look at the conference board, the dialed optimism back a bit. So you're starting to see some disconnects. So wages are there flatlining. We do see them rolling over as we talked about in segment one. And it's starting to show up in the conference board data. Typically, conference board leads the Michigan one a bit, and that's where we see that problem continuing to the downside and showing some of that additional pain. Now, this is what we were talking about on credit cards. Personal interest expense as a percentage of DPI, when you look at that long-term history, personal interest payments as a percent of personal DPI are rising, but still below pre-2008 recessionary levels. Now, a lot of this is being driven based on auto loans and credit cards, but the lion's share of it is credit cards. Mortgages are very low. That's affordable. So the interest payments or that missed percentage is going to continue to go up as a percent, not because of mortgages, but because of credit cards, which is why that compounding piece becomes the bigger problem. Estimated annualized cost of servicing U.S. government debt is coming close to $1 trillion. And that's the problem that we see. It's not only just a corporate spending problem. It's not just a consumer spending problem. It's obviously a government spending problem as well. So when you look at the fact that we're going to have to recognize that we can't afford to continue to roll debt, and not only roll debt, but issue new debt at these prices, because you're going to end up spending more in interest expense than you are on the social services that you hope to provide. And that's where we have to get smart. We have to get focused on identifying places to cut spending and to really tighten our belts. because the delinquency by type of debt, when you go back through time, consumer loans, consumer credit cards, auto loans. But it's interesting because consumer loans lead auto loans lead credit card loans. So when you look at this growing delinquency, you can see how it starts, how the rate of change is very similar to 07. But even as we went into the recession, it didn't stop. It only accelerated. And the problem is, this point in time, credit card rates are at the highest they've ever been. And that's going to be an overarching problem, which is why retail inventories continue to grow at such a heavy clip. And it's interesting because U.S. real retail inventories are at levels that are way above pre-COVID levels. And you're starting to finally see that crack, because this is showing that, you had that inventory come in and now you just don't have the consumer showing up. Again, showing that pain that we've already seen in PMI when you look at services, where you're seeing that slowdown. And again, we do see that going into contraction. Latest update from the Consumer Conference Board index shows a negative spread between expectations and present situation, stuck in a range, and history shows that the surge back into positive territory would be consistent with a recession. So again, nothing too different here. But it's important because people, have these crazy views on, it's like, oh, it's manipulated data. And it's manipulated in I guess, some ways, but when you look at the responses, so just take the BLS response rate for job openings and labor turnover. For years, it was 65%. It's at 31%. Response rate for non-farm payrolls has gone from 60% to 42%. So when you look at a lot of these revisions, some people will say, oh, this is Biden economics hiding information. And it's really not hiding information. It's just people aren't responding because they're angry. They're at work. They're working 2 jobs. They don't have time. And this is a problem. And this is why some of the data has the volatility, which is why we look at so much, which is why, unfortunately, these are a bit longer, because there's so much data that you have to go through to find the trend. So where are we going? How is it pivoting? Because some of these tried and true pieces have gotten worse. Year-on-year change in job openings rate for manufacturing sector still hovering near record low and in deep negative territory. Again, that's something that the levels are still well above pre-COVID, but you're going to continue to see that move down. But again, there's still more work to do, which is why we see some of that pressure continuing. Capital good orders, non-defense, ex-air continuing to see softer year-on-year trend in line with historical recessions, but also with slowdowns that weren't consistent with broader downturns. So again, just kind of flatlining. We do see some of that slowdown, but it doesn't come all at once. Now we look at some of the leading indicators. Regional Fed data continues to roll in. New orders component look to be stabilizing around current levels, which is in contraction, but worth keeping in mind that some, like the Empire Index in orange, still look very volatile. But for the most part, they're bouncing, but in contraction. Dallas Fed minus 15.8, Empire minus 19.9, Kansas City minus 6. This is what we've said. It's going to get to a point in contraction and then go sideways. So then when we look at Dallas Fed manufacturing outlook, capital expenditures, negative 8.6. So again, the downtrend is intact. Texas service sector outlook is at negative at 12.6. But again, all moving in the negative direction, which is a leading indicator, because remember, CapEx is needed to invest in companies, invest in people, and that is what we are not seeing. Dallas Fed manufacturing new orders coming in at negative 15.8, production business activity negative 11.2. Again, the downtrend is intact, and we see it leveling off, but leveling off in a contracting standpoint, which is not, again, just showing where the direction is going, while expected prices paid bounce higher. Stagflation. That is the definition of stagflation when you look at a slowing economy with that inflation going up, that pressure going up. August Chicago PMI moved to 48.7 versus the estimate of 44.2. Prices paid rose at a faster pace. New orders popped back into expansion. Employment contracted and production moved back up. Net, it's still contracting at a slower standpoint, but the consistency in prices, because again, new orders up, new orders down, net, still contracting. The one thing that is consistent across all of them is a reacceleration in prices paid, which has never gone into contraction. Instead, it just remains at this elevated number. Kansas City Fed 6-month manufacturing survey for new orders is expected to move a little bit higher. But again, you can still see we expect it to come back down and kind of bounce back and forth at this muted pace. August Dallas Fed manufacturing came in at negative 17.2 versus the estimate of negative 19. New orders up to negative 15.8. Prices paid jumped to 17.4. Wages jumped to 34.9. It's like that is a huge number when you think of wages. Wages jumped up. So we see some pieces, nationally speaking, wages are moving a bit lower, but there are pockets of it going back up. That's going to be difficult when you look at the Fed and what they're trying to achieve. Prices paid component within August Kansas City Fed manufacturing index bounced back, but stronger gains was in the 6-month outlook. So again, all moving in the wrong direction when you think of inflation. Prices paid components within regional Fed manufacturing indices bounced for Dallas Fed. Forecast for new orders dropped. So again, you're seeing that increase in price, drop in new orders. All that pressure continues to play out. Latest update from University of Michigan Consumer Sentiment showed that expectations for better financial situation moved up. Per the latest University of Michigan Consumer Sentiment update, respondents continue to that growth, more optimistic around unemployment into the coming years. So you're starting to see, again, there's that bifurcation, and it's all a matter of when it was taken, because the University of Michigan was first, Conference Board was after. So you saw that as that inflation moved through, some of this pain that has really accelerated from the back, all through August, but really started to compound on itself at the end of the month, impacted some of that timing. Rates still an intense headwind for would-be homebuyers per the latest update from University of Michigan. Real estate investors have pulled back on home purchases to the tune of 45% year on year. Aside from the first quarter of 23, it marks the largest decline since 2008. So again, real estate investors are pulling back. They're looking at this, they're saying rates are too high, prices are too high, I'm not a buyer. And this is, I think, a bigger issue because they've been such a big buyer for so long. Them stepping back and actually liquidating a bit is going to put pressure on the market. With new home sales soaring and rest of the market mostly frozen, 30% of all single-family homes on market are now new, which is among highest share throughout history. But in new builders, builders are going to struggle to flip this home to then build a new home, which is why you see some of these slowdowns. Pending home sales year on year stayed negative, but it moved to negative 13.8, but continues to improve from recent depths. But again, you kind of get to the low and then you bounce and go sideways. And that's what we're seeing here, this kind of pause, especially because home price indexes month on month went up. You saw it at the U.S. national average. You saw it at the 20-city composite. And this is a problem for the Fed because they need this to stop. They need home prices to come down, and they're just not getting what they want, especially as U.S. commercial property prices move down. They're getting what they need or what they want in commercial real estate. It just has not moved down to the residential market, which we do think it gets to. Gap between buyers and sellers' price expectations on U.S. multifamily apartment deals is now below where it was in 2020 and continues to fall aggressively. And it's actually closer to where we were in 07, in 06 into 07, which is why the price isn't right and prices have to come down in order to see some of these transactions transpire. The stress levels in U.S. commercial real estate continues to move up. We're well above where we were pre-COVID and getting worse, which again, if you look at what happened as we got into 06 and then ramped into 2010, we're going to continue to see something similar because the expected U.S. commercial real estate returns versus corporate bond yields, the spread just isn't there, which is why there's no reason to be in commercial real estate when corporate bonds and treasuries, but you need to keep seeing that. That's how you pull that money away and purge the system a bit from the frothiness that we continue to see. Active home listings have continued to tick lower. Total fell by 3.9% in July to the lowest level on record. As rates move higher, buyers' budgets are getting crunched. For home buyers on a $3,000 monthly budget, a $429,000 home is affordable with a 7.4% mortgage. In August 2022, a $500,000 a house was considered affordable with a 5.5% mortgage, a loss of $71,000. So you get an idea that as rates go up, your interest expense goes up, so your ability to afford that comes down. So you either have to go look at a cheaper house or a smaller house, or the price of homes have to fall, which is again where we see that disconnect in the market. Investor purchases on the national average remain at lows. National investor market share continues to roll over because you have these big buyers that are stepping back. And that's where we see the Airbnb, that turbo thing starting to reverse, which will help put some additional volume into the market. Pending home sales came in at 0.9 versus the estimate of -1. But when you look at the pending home sales, you're still at a very low level. You're just kind of flatlining. But pending home sales is not matching with U.S. Mortgages. And that's the problem, is you might agree to buy this, and then you go to contract and you fail to get the mortgage. And that's what's something that continues to play out, which is they're not going from pending to close, they're going from pending to fallen through. And that's a problem that continues in the market. Home prices for the FHFA came in at 0.3% versus the estimate of 0.6, but still moving higher. So again, when you look at the core logic that's bottom right, which we had earlier, and the other home prices, you see that stickiness, which is a concern for the Fed. And that's something that they're going to continue to address by trying to push lower. And this just looks at, again, that home price shift that they are trying to, again, move gradually, for the most part, to the downside without shocking the market, which is a very tough needle to thread, if you will. So that's what we have for you today on the U.S. In the next segment, we're going to go deeper into Europe and some of the key pieces that are happening in Europe right now.